Uh, a very good evening, everyone. I am CS Sanit Tushar Mutta, the chairman of Ahmednagar branch. I'll be the moderator of this webinar today. First of all, I'd like to thank CP committee for this opportunity. We are delighted to welcome you all in the webinar being organized by the Continuing Professional Education Committee of ICI. It's my pleasure to be a moderator for the webinar on credit assessment in banks, which is going to be taken up by CS Sunny Sabarwalji, and practical training tips for raising cheaper funds by large corporates, which is taken up by CA Harjit Singh Puri. In a short while, we'll start this webinar. First, I would like to appraise you about CP committee. In today's ever-changing professional scenario worldwide, the biggest challenge the professional face is how to stay on the top of their game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date, to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, continuing professional education facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through seminars, etc. Uh, the program for this evening will be as follows. We will have two sessions of 1 hour each. And the topics are credit assessment in banks, taken up by CS Sunny Sabarwalji, and second, practical training tips for raising cheaper funds by large corporates by CA Harjit Singh Puri. Our eminent speaker will talk about the above to mention emerging areas of professional interest. We'll also be having a short question and answer session. So I request everyone to please post your questions. The question and answer session will be taken up in the later part of the session. 10 minutes question and answer session will be taken up. So now, without much ado, I would like to introduce our first session speaker, CA Sunny Sabarwalji. We are delighted to have with us CA Sunny Sabarwal, a seasoned financial professional with over 17 years of experience across some of India's most reputed corporate, naming including Axis Bank, Centrum Group, uh, Care Ratings, IDFC Group, and CRISIL Limited. His vast expertise spans credit rating, financial analysis, bank credit, budgeting, forecasting, cash flow management, consulting, strategic planning, and risk management. CA Sabarwal is particularly known for delivering CFO service to small and mid-sized corporates, ensuring their financial strategy align with long-term goals. So, with this very brief introduction, I hand over the charge now to Sunny sir. Over to you, sir.
Thank you so much, CS Vanith, for the introduction. And I'm really grateful to the Committee of Continuing Professional Education for inviting me to deliver this lecture. And my warm regards to our other speaker, CA HS Puriji. And in today's session, I will try to bring out whatever I have captured in my past experience of 16, 17 years with banks, with NBFCs, with rating agencies. So the idea is to bring out those things which we as chartered accountants, as advisors, we can bring out and try to add more value to the loan transactions that we are doing right now. So just to take support of a small presentation which I have prepared for the benefit of the attendees, I'll just upload it and we'll start the session there.
Sir, I'd like to update that right now 251 attendees are attending this webinar.
That's great. I hope we are able to share our knowledge with them. And I would really appreciate any questions which come across. Please feel free to ask them. Let's make the most of this session by doing a two-way communication rather than making it a classroom. So thank you so much. And I'll begin the session now.
Yes.
So my introduction has already been given by CS Sunit, but just to do a quick recap. So I've worked at various rating agencies, lending institutions, consulting firms. My major area has been financial analysis. I've been analyst my whole life, and numbers are what I'm, little bit good at. So whether it is analyzing financial transactions or whether it is preparing financial models for companies or for project financing. I've also worked on REITs, real estate investment trust. I'm as a passion, I am a orator. I am also a teacher. I am a trainer. Been to places for delivering lectures on financial statement analysis, bank lending, credit assessment at banks and various places. I also write in financial dailies where the articles have been published mainly on economics and financial markets. Okay. So this is broadly the agenda that we are going to target today. Please note that the entire discussion will be on mid or large corporate loan funding. So here we are not going to talk about certifications. We are not going to talk about any other type of services which the chartered accountants are providing, apart from the advisory services that we provide as advisors to our clients. So, what are the services that we provide or can provide? What is the lending process? The credit assessment, how banks basically analyze a proposal. What is the role that we as chartered accountants can play in debt advisory? And some, trade hacks which we can use to ensure that the transactions are taken up very smoothly. So basically, I'm just going to start off with generally what I have seen when we act as advisors. What is the conversation which happens between a client and their advisor? So basically, a client says, "Okay, there's a meeting. I need a loan of rupees 50 crores term loan," and the advisor says, "Yes, sir, ho jayega." So the client says, "Are you sure?" "Yes, sir. We have connections. We know a lot of people. We will be able to do it." So any information that you require, do you think that we are eligible enough to take so much amount of loan? Sir, I'll ask the banker and I'll inform. By when do you think that we will be able to close that transaction? The client asks, and we say, sir, very soon. So now this has come when I have worked in the rating agencies and consultants are playing the role, or when I have been at lending institutions also. And now when I am myself an advisor, now I'm on this side of the table. Here also, when I meet people, I meet advisors, how they basically approach the corporates when they're going for a meeting. Now this is, I think you all are aware of how these transactions are, these meetings are handled. What are the ills of such a transaction? What is it that we are basically missing out on such transactions? I'll quickly rush through that. So basically, first is that the client doesn't think that we are adding any value to the transaction. Okay, for them, we are just basically being just a middleman. We are not adding any other value to that. Second, we are acting as a courier. So we are taking documents from the clients and we are submitting documents to the banks. So the banker also thinks that, okay, there is no value addition which is being done apart from this. Then next is that the client, after a particular point of time, the client directly starts dealing with the bank itself. And our role as an advisor actually either diminishes or even gets wiped out. Because again, there is no value addition on both the sides. So why will anybody like to have another step in between? Then we repeat the same, the discussion happens over the years. I've met people who are into, even 15 years, 20 years in the same industry, and they are having the same conversation again and again, again and again. And ultimately, we don't add to our knowledge also. So just being somebody who is, acting as a courier service or not, facilitating the transaction in a real sense by adding more value to it, we basically get wiped out through this entire ecosystem. Now, these are the services that we basically, as chartered accountants, when we act as advisors, these are the services that we can provide or we are obviously providing right now. So one is a project appraisal, where basically we are doing a thorough analysis of any particular project, the financial analysis, economic analysis, technical analysis. By technical analysis, I'm not meaning to say that we are performing role of a technical engineer. But whatever information that we can gather, for example, there's a power plant, then we are able to assess how much will be the requirement of the machinery which will be there, who are the major suppliers who are already operating in this industry, how much will be the core requirements. So these sort of technical requirements I'm talking about. So basis this, we prepare project appraisal reports which are taken up with the lenders. We provide debt syndication. So basically, if there is any large corporate where for a single transaction, there are multiple bankers, so we play an important role there also. Then financial documentation basically means that when we are assisting a corporate to take a loan from a bank or an NBFC, then we are providing the support in terms of documentation when they have to prepare the credit note, which is presented to the credit committee. So for that, we are providing all the documents which are required, whether it is financial documents, whether it is income tax returns, whether it is operational statement, whether it is stock statement. So all those kind of documentation that we are providing. Then negotiating with the lender. So this is a very important part. When we understand what is the lending process in totality, we are able to provide the right advice to our clients also. Now, this happens only when we understand, okay, if, for example, just to take a very simple example, the lender is asking for a higher rate of interest because they see that, okay, the client has the loan transaction is carrying higher risk. Okay. Now, there our role as advisors is basically to understand what risk they are talking about, how that risk can be mitigated, and providing those mitigants to the bank. Okay, whether it is a higher security that the bank is asking, or whether it is a higher amount of collateral or anything like that, or covenants. Covenants are a major part where we can add a lot of value to our clients. So if there's unnecessary stringent covenants which are being put in by the banks, so there also we can negotiate from our client's perspective, and we can try to make it beneficial for our clients. Then post-funding advisory. So this basically means that now as advisors, our role is not only till the time when the loan drawdown has happened. Now we are even going a step further. We are not asking our client to, okay, let us tie up this loan for you. We are now saying that let us handle your loan portfolio. Let us handle your banking. So what this includes is that once the loan has been drawn down, then we basically start interacting with the bank on client's behalf for all the requirements, whether it is a submission of quarterly stock statement, whether it is for getting their inspection done, whether it is adherence to any particular covenant, financial, non-financial, positive, negative, whatever kind of covenant they have asked for. And in fact, monitoring their utilization. If we are seeing that, okay, for past few months, the client's utilization levels are shooting up, okay, they are crossing 90-95% for working capital limits. There also we can add value by advising our clients how they can reduce the burden on the working capital limits, because once they overshoot for a consistent period of time, then the banks will become they will try to avoid any higher limit before assessment. If the assessment allows, then they will obviously welcome to give us higher limit, but if it is not, then we have to see how the operating cycle can be loosened up so that the utilization levels come down. And lastly, we should also monitor that what is the future requirement of loan that is going to come up. See, we are the ones who are having the entire control on the financials of the client if we are that kind of advisor. So basically, we have the projections which have been okayed by the client, which have been accepted by the bank. So we know that, okay, the client has projected, say, for example, 100 CR of term loan because they are going through expansion in the next year. Now, maybe they have called us for only 25 crores of loan tie-up, which we have done very well based on the knowledge that we have. We are obviously going to want to take that share of the remaining 75 CR also. Same can happen with working capital limit. Same can happen with any project with the client is projecting. So all this can happen when we are consistently there with our client for their financial control. Not only when they are telling us to take a loan, but we can also keep that control. Now the question comes that this is basically which I want to thrust upon, that why the loan applications are rejected. This I have seen again across my experience and what I have also learned from others' experience. So one is that basically there is a poor credit history, whether it is in terms of the personal score of the promoter, or it is any past defaults or delays or NPA status of the company, or it has been that the loan has been rejected by various on various occasions by banks. Now, every bank, when they put in an application, it is sort of permanently entered in the bank system. And again, after some time, my application is put in the system, say for example, after 6 months or 1 year, then that the system already shows that, okay, this application was already rejected for so and so reason. So the point is that we should be very careful when we are introducing our client to any bank, because that data becomes permanent and it can scar the credit history of the client. Then if there is inconsistent, or you can say the management is not trustworthy, now this can be because they have been into some litigation, they have been some under some fraud case, or the company has already been some raids have happened. Now I'm not saying that only because, see, it's not that because of only one reason the loan might get rejected, but it can be one or more reason which can lead the client's application to get rejected. Now when I say rejected, it doesn't mean that the application gets rejected only at the end when the credit committee, जब case चला जाता है credit committee में. It can be when you are discussing the case with an RM and RM says no यार हमें, we don't want to enter into any transaction because of these reasons. Okay, so it can be at the rejection can happen only at the RM stage when we are discussing, or it can happen at the last stage when the credit committee takes the call. Now, because of inadequate collateral, this especially happens for new companies or companies in the service sector where they are not able to provide that much of collateral. Inadequate financial strength. So this is basically where the bank feels that, okay, the company will not be able to, based on the current numbers that they have provided, they will not be able to repay our loan, or they are going through some kind of financial trouble, whether it is getting reflected through ratios, or it is getting reflected through the sales growth or profitability growth, or if the business is already loss making. Incomplete documentation, this generally is very rare case, because documents, every advisor is very sharp at providing the documents. But if there is any for example, in case of collateral, if there is any conflicted property which is there, so that can also be a reason. The ITRs for the sufficient period of time are not available. Then the reason can be that there is very baseless, I'll say, baseless business plan which has been submitted. The client is showing, okay, I'm in a very sunrise industry, I'm into EV component manufacturing, and we are going to see very large growth. We are going to get orders from Ola, we are going to get orders from other companies, and based on the whims and fancies of the promoter, the projections have been prepared. And basically this is where our value addition comes in. Even if we don't need to beef up the projections or the numbers or the proposal to get it cleared, because today the banking has changed a lot. If you go 15-20 years ago, they might have sailed through, but in today's times, even the RM who has been a credit analyst at some point of time, or the credit analyst who is doing your case, so basically they are not going to just rely on your numbers. The credit committee always asks the credit analyst to prepare their own numbers. So even if you give a very fancy projection, it is not going to work out. Company is expecting to double their top line in the next 5 years, but there is no increase in capex which we are shown. So these are just examples. Okay, there is some, for example, the company is into export and they have not considered hedging at all. So obviously the bank can provide that facility, but what they want to see is how robust the proposal is. Does it capture all the risk and the mitigants or not? Then unclear use of loan. So basically it is just that client wants money and they have asked you to get that money, but it especially happens in working capital. But now the banking systems, with so many RBI regulations and norms, it has become very, and post the cleanup of the books of all the banks, it has become very prudent. Every investor call, before that, around the NPA levels, the CMA status of every client account is taken up very seriously. So it will not happen that we give a half-cooked presentation. And I have seen these cases, where the preparation is not done properly, and this actually leads to the rejection. Now, just quickly, I know you must already be knowing all this, but just to give a quick recap, what are the type of loans that basically a bank deals with? So one are asset-based loan. It can be any mortgage loan which is there. Okay, so the loan is secured by that asset which they are financing, and that's why the rate of interest are comparatively lower, because the security is there. Then there are cash flows loan, like working capital loan, general corporate purpose loan. So there the cash flows the repayment is based on the cash flows of the company. There's hardly any security apart from the overall security which is there. There's trade finance, where basically we are facilitating any export or import transaction, and there are leases. Okay. Now, what is the lending process? Again, many of you might be aware, but for our younger members who are joining the session, I'm just going to quickly take you through that. So once there is whatever may be the name, but there is a preliminary application which is filed. In principle, approval from the bank. So there is a request from the company for a bank facility, which is jointly prepared by the RM and the analyst. So this first part where the primary application is being sent. I think this is again very crucial part. I have tried to highlight the portions where we can add a lot of value. So when the proposal is being discussed, even at the initial stage, there also I'll share what value addition we can do, but we need to be there throughout the transaction. Once the preliminary application is approved, then we have a detailed assessment. So detailed assessment is basically a 30-40 page, whatever is the bank's format. So there is a proposal which is prepared. Once that proposal basically takes into account the regulations of RBI and the bank's credit policy, and if there is any sector specific considerations in the bank's policy, then the sanction is done. The post sanction, the analyst has to prepare a sanction letter, which is then negotiated and signed with the client. The analyst has to make sure that whatever was approved in the credit committee, the same gets reflected in the sanction. Then the disbursement happen. This is the bank does this in consultation with the treasury team, their treasury team. The RM has to ensure that the availability of funds is there. And before that, the analyst has to make sure that all the pre-disbursement conditions are fulfilled. Once it is done, then there is a regular monitoring and review of the account. For example, quarterly statement, quarterly financial accounts, which have to be submitted, any certification which was required to be done, credit rating if it is post-disbursement condition. So the branch takes all this information, and the analyst has to monitor all the covenants which are there. So this is broadly the bank lending process which is there. Now, in lending, there are two broad segments which are there. One is the small and medium enterprises, one is the large corporate. So basically in the what are the peculiarities which are there? So in SME sector, the scale of operations is very low. So the reason for that is either it is a very new concern which is set up, say, in the last 3, 4, 5 years, or else they are not into a lot of products. They are mainly into, maybe there's a concentration of a product or in a particular client or in a particular geography. And in these cases, you will find that there is a very, so they are mostly dealing with 1 or 2 suppliers only. And these are the companies which mostly fall in the tier 1 and tier 2 supply category. Then there is a very thin line between the ownership and the management, because of which the corporate governance becomes a very major issue. The banks usually try to take a very small duration exposure here, because they don't want to take a long-term risk due to the reasons. And the availability of collateral is also very less, because the businesses, if they are new or if they are small, the promoters have also not been able to have earn that much amount that they can have a lot of properties in the company or in their personal wealth. So that's why the amount of collateral available is also very low. Now the peculiarities which are there in the large ticket lending. So basically they can be multinational operations, they can be very diversified businesses, and then there will be competition among banks, because each bank would want to take a share of the pie, because these are very strong businesses. They have a legacy, they have diversification, their credit profile is very strong. There is in fact a very strong bias at the top management of the bank to be part of these companies. Mostly you will find them in consortium lending also. And the lending process also is influenced to a large extent, though the bank will not try to take any unnecessary exposure, but still because of the competition and because of the management connections, they are able to influence the process also. So out of these, for an analyst, the multinational operations and the diversified business becomes very difficult to assess. Though the history of the company becomes a very major guide in this. Now, what are the mistakes that we generally do? We have done a sort of a skit earlier. So, what are the issues which the because of which the loan applications basically gets rejected? So, if you see, it is poor understanding of business. In fact, recently only there was a case where our client wanted to, not my client, but I was approached later on. A client which is in solar EPC wanted to take loan, working capital loan, but the loan application got rejected from the three banks because the earlier advisor basically they were not able to explain, and it never even reached the CAM stage. So basically, it was rejected at the RM level only. So it can be the poor understanding of business. It can be because of fancy projections, or sometimes now we get the projections made from Chat GPT, which is again very funny. How can we do that? And, or if there is any lack of clarity on the project, why the company is setting up that project, is it making sense, whether the financials are supporting, from where the funding has to come. So I think post these mistakes, I really wish that we transform our role from a courier service to an advisory service. Rather than just taking document from the client and mailing it to the lender, let's just so I'll in the end I'll also share that how I try to do these transactions. So maybe that can help to those who are trying to venture out new. Now these are the key factors which basically are considered by a bank when they are doing the credit assessment. So there's a management evaluation, there is a financial evaluation, business performance, cash flow analysis, collaterals, market conditions. Now, if you are someone who is more than 10 or 15 years, who has been in this industry, they will very easily appreciate the fact that the requirements of the banks has increased so much. Now the bank also asks so much of operational data, capacity utilization, um, stock levels. So I'm not saying the requirement has increased this year, but over a period of time, there is so much of information that a bank requires. And now this is in fact better, because now there is more value addition that we can do to the case. Since more information is required, which our client might not be able to convey. So idea is not that we are going to replace the client and we are going to generate an information. The idea is that the client is busy with their work, or they don't have the expertise to deal with the type of information, the form of information which our bank requires based on these parameters. And there we come in and we provide these information as per bank's requirement. And that's where we are creating a value, and that's where we get a lot of references also, because we are able to do the transaction with minimal time and effort from the client as well as from the bank. So we are going to discuss these in detail. So basically, starting off with the management. So we have to see whether the management is experienced in the same field or not. So just for an example, Mark Zuckerberg leading a chemical company, so it will not be a very good idea. So we have to see if the client is whatever experience there has been there, whether the client is a first generation entrepreneur or they are in the second generation. The experience matters a lot. It basically leads us to the second point, whether they are equipped to handle the headwinds. So there can be situation where, for example, COVID, it had hit the world hard. Now, in such case, how the management has been? Was it that the management was able to sail through because of, the risk management that they had done before even the disease, the pandemic taking us? They had sufficient cash surplus which were there. Their costs were optimized. They were able to get bank funding because of their sound track record. So because of these reasons, they had not fired a lot of people. They had not sought for restructuring and stuff like this. So basically, how well they are handled, and then the intent. So whether the client has the right intent to pay back the money, they are accountable to the stakeholders, or they are fraudulent of nature. Then, if there is requirement, whether there is representation by the independent board of directors who sort of act like whistleblowers if the need be. One of the things which I have done myself, whenever we are looking about this, we should always run a Google search for the promoter name. If it is new, it will always, and the company also, so it will throw up any negative news which is there. Then knowing the business, I think this is the crux. I cannot call myself as an advisor. as a professional advisor, if I am not equipped to know what the business of my company is. I am assuming in this case the chartered accountant is not already the auditor or handling any other work. This is a fresh case where somebody has approached me to as a loan advisor. Okay, so and what is a business? So if I have to explain you about, say for example, for example Swiggy, if I have to explain you about it, so or if it is any plastic manufacturing company, okay, or any auto component manufacturing company. So basically what is the where the company has its plant, where the what is the how the raw material is available, from where they buy the raw material, who are their customers, what is the capacity utilization right now, what is the how much manpower they are using, what is the distribution channel, what is the product mix, which are the products which are giving very good sales, very good profits, which geographies they operate in, which geographies they have major market share also, what is the kind of level of integration. So integration means backward integration or forward integration in manufacturing supply chain which they are doing, the kind of technology. Now, assuming someone who is only a chartered accountant, it is not expected that they will be, sort of technicians. So I consider myself as a generalist. We can have a fair idea about a particular industry, but we are not technicals. We don't know at what temperature steel will melt. So, for example, and it is not expected from us to do so. But the idea is, if I have to, in a very plain and simple language, if I have to explain this entire business to somebody, that is the kind of download that you have taken. And what is the best source to get all this information? The best source is the management itself. When I for getting the loans or for credit rating or any other assignment, when I speak to the clients and when I ask data, the major observation which I get from them is that why you are asking so much of information. Our earlier advisor never asked for this. So basically point is that we need to ask the right questions, and for that we need to know what is the information that is required by our lenders, and all of this information is required. All of these information are being put by the RM and the credit analyst to their committees, and the more robust proposal we have, the better conditions we can expect for the loan also. Then we should have sector knowledge. This is very crucial if you want to be called sector specialist. For example, अरे यार auto sector का loan है, speak to Mr. So and so. For example, that person has considerable amount of knowledge. So whether it is the growth in the sector, what are the regulations which are there, who are the major players, who has the market share, what are the issues, bottlenecks, what are the concerns which are there, what is the future outlook of that particular sector. So we are not here to mug up that information, but we have a fair idea of what the sector is going through and what can be the source of that information. First is the management. Management will be able to tell us about how the sector is performing. Then the bankers will be there who will be able to share this information that okay, yes, we are in this sector mein hum dekh rahe hain ki there's lot of traction, lot of government is also supporting this sector sort of. Then news. We all obviously will be following news for general purposes also. Then credit rating rationals and reports. So if you I give this as a very good hack to people who want to know about a particular sector. Whatever sector that you are looking for, say for example it is steel manufacturing, try to go through the rating rationals of about 5 to 10 companies of that particular sector. You will largely of the investment grade companies. Now, because of the requirements given by SEBI and RBI, the rating rationals are also, now this is credit rating, okay? So credit rating rationals, they are available free of cost. The report are paid, but the rationals are free, which runs into 3 or 4 pages. They will give you what all information the analyst has considered. So there is a mirror analyst which is there in the banks. Like rating analyst, the bank also does the similar credit analyst which is there. So you will find a lot of commonalities between their both analysis. Then if there is any, if the sector is obviously covered by the equity research, you will find a lot of information there also. So this is just to equip ourselves with the knowledge of a particular sector. Okay. Why? Also knowing the sector helps us because of there can be different accounting norms which are there. For example, real estate is a very different animal. There is a very different accounting which happens. Revenue recognition is very different there. We will be able to find out which how the cash flow phasing also happens. For example, in real estate, you will find that mostly the funds come in at the launch of the project. Then there is a considerable stable cash flow which they see. Then industry specific metrics also which the banks also see. For example, in hotels you will find an average room rate, okay, or occupancy levels, but they will be different in a manufacturing setup where you will be looking at the utilization levels, where you will be looking at the average cost per ton, average revenue per ton. So having knowledge of the industry will also help in writing better proposals. Then this is our core area. So I'm not going to spend time in telling you what is a balance sheet, how to analyze a cash flow statement. We all are already, CA curriculum is very thorough in this. We are considered an authority in financial statement analysis. But just to give you quick hacks of what all things are very important from a banker's perspective. So how much has been growth in the particular company vis-a-vis the sector. Okay, the sector means that okay, now they will be organized and unorganized. We are talking only about the organized. Then how much is the sales or profitability segment wise? Okay, so for example, in a auto manufacturing company, it will be like EV, commercial vehicle, personal vehicle, two wheelers for auto players. Then how assessing the profitability also segment wise, region wise, product wise. Then checking for the non-operational profit. So these should be ideally one-time items which are there, if they are considerable. Okay, but if it is only treasury income or interest on deposits or some duty drawback, so these are very common items. Though they are categorized under non-operational, but they are very recurring items. We are looking for non-recurring large items. Okay. Then quality of earnings, when you look at the cash from operating activities, how cash from operations, how much is it different from the profits of the company? If the difference is considerably large over the years, then that means that obviously there is some window dressing which is happening. Then very basic of financial statement analysis, checking the solvency, liquidity. Two things that we generally not pay attention to is generally the notes to accounts and the qualification if there is by any auditor. Okay, so basically while analyzing the balance sheets, we simply start with the balance sheet and P&L and cash flow statement. We pay very less heed to what are the notes to accounts, what are the information which is given there. Okay, so for ratio analysis, again, you have to compare it with the previous period, also with the peers in the industry. Now it can be that the 10% is very high because it's a very sunset sector. Still, the company is doing a 10% growth or a stable industry, and it can be that the 20% is also less than average if we compare. So there is no a single number will not tell us any story. So if there is any deviation from the previous period, so for example, the current ratio has suddenly dropped or has suddenly shot up from the previous period, what is the reason? If we don't investigate them, then the ratio analysis is meaningless. Then these questions come very often to me that what is the high amount of debt? So there cannot be a single number which you can say. For a company, even 1 CR can be very high. For a company, even 10,000 crores can be small. So it is basically you have to see in relation to it. Every number has to be seen in relation to some other number. So debt can be seen in relation to the equity or the net worth or the profitability or the cash flows. So just to say why the company is making a higher profit, is it better technology? Is it better pricing strategy? Is it cheap material sourcing, or is it window dressing? Now one can say why we are concerned with this. So basically, would you want to represent a fraudulent client to a banker? And let me tell you this, as a banker also, I would never want to deal with advisors who bring shady deals. Nobody wants to put any spot on their track record. So if there is any advisor who brings us deals which are already there with 10 other lenders and it has got rejected and all, then you will obviously want to stay away from such advisors and such companies. So that's why getting into these details is very helpful to us. And notes to accounts, they are very useful. So basically you will get very apart from the numbers which are already there in the summary balance sheet P&L cash flow statement, you will find a lot of information there. For example, if there is any change in method, why that change in method has happened, what is the impact on the numbers. We all know these things are there, but I'm just trying to re-emphasize these points. So if there is any convertible debt which is there, what are the conditions of that debt? If there is any convertible preference shares, when or they are redeemable preference shares which are there, then what is the condition when they have to be redeemed if they are not compulsory convertible? What are the off balance sheet items which are there? How much is the discounting which the company has done? Contingent liabilities, what is the amount which is there, and is it considerable? Is it that the company has been struggling for some claims which have been made by the customers because of the products that they have manufactured? What is the risk? Now, forest risk, credit risk, all interest rate risk, these all risks are very clearly published on the balance sheet. So going through all these related party transactions, if we see that, okay, suddenly the related party transactions have increased, what is the reason for that? So all these things bank is already analyzing. I'm just trying to tell you that these things we can also go through so that we can answer the bank's query very well. Then what are the adjustments that as a bank analyst you generally make? So except bought out goodwill, you will not consider any intangibles which are there. Revaluation reserve is just a book entry, so you remove them from net worth. If there is any unquoted equity investment which is there, so generally we consider if it is in a group company, then also it should be considered as a non-current asset. And in fact, if it is a loss making or a project under implementation, we remove them from the net worth also. Any capital advances which are there, so capital advances are advances which you have given to the supplier of a capex that you are doing, so that are also included in capital work in progress. So this list is not exhaustive, but what I'm trying to say is that even as a credit analyst at a bank who is preparing that CAM, which is going to be presented to the committee, you have to basically look behind what the number is saying. Say, for example, if there is an inventory, every bank, even in the stock statement that we submit, they obviously remove any long due receivables or any long dated inventory which is there. If there's any large forex exposure, so large again means in proportion to, if it is proportion to sales or the purchases. If there is any particular large exposure to of forex, what is is there any natural hedge which is available, or the company has already adopted any hedging mechanism? Any unsecured loan which is there, and this is very common in the small and mid corporate segment. So promoters generally very frequently introduce loans rather than direct equity. Banks always make sure that these are subordinate to the bank debt. So what is the track record, whether the company has been consistently bringing in those funds to support the operations, and what is the interest rate that they are charging on these loans. So this gives more comfort to the banker to consider them as part of the net worth. Then refinancing, if the DSCR is falling, at a very suboptimal level, then what is the refinancing plan of the company, and what is their history of refinancing also. If there is any group entity which is there, then what is the ownership structure? How much holding does our borrower, our client hold in those companies? Whether they are just whether they are actual operational companies, or they are just sort of shell companies which are there. What is the linkage? Whether our client supplies to a particular customer through that company, or they are setting up a different separate project in that company. What is the support nature of operations? And then what is the linkage that financial support which our client is providing, whether it is in terms of guarantees only, the company is already operating now its own, or there is a constant funding support which is there. You will find that the bankers for these companies are also same as the parent companies. So these metrics obviously help us in a deeper understanding of our client. And before moving on, let me tell you, as an RM also, you would definitely want to discuss your case with somebody who has these are very basic things. These are very basic things. I think any advisor, if spends less than a day, they can get a very good idea about this. Again, we are not here to mug up or cram this information, but we are aware if there is any of these things which are very important. Any bank credit note will have all these information. By default, they're going to have this information. So we are supposed to know about all these things. Then CMA is basically credit monitoring assessment, the typical Excel file which we do, and you all must be, so many of you must already be doing this, but just let me tell you what are the key issues which we key problems that I have seen as a lender. One is accuracy. So basically people just try to copy paste the numbers from the client's very poorly constructed Excel sheet. So never copy the numbers, especially the past ones. Try to, get it done yourself. The projections without assumptions of any sales, cost, capex, debt. So that number doesn't tell me the story. How do I make out why your profit is suddenly rising? Then there is no justification which is there. You can simply add a lot of, you can add comments before sending the file to your banker. You can add comments in Excel also, so that can tell the story. It will save their time also. Or if you are writing about these in the credit note yourself, then also you can mention these things. Capex and sales, I am again and again pointing out these because I see major lacunas here only, that people are just arbitrarily taking any number for sales growth, and again taking arbitrary number for capex also. There has to be a linkage between them. Then debt servicing, take debt servicing from the sanction letters, don't just take whatever number the client has given. Then investment in group companies, what is the rationale? We recently, just now we discussed this. Why is that being discussed? How much will be the future requirement if the company is setting up, say for example, a captive power plant? They have shown that okay, they have made this much investment. How much is the future investment? How much is the project cost? How much is the funding that they have to take? Is the debt funding for that group company project has also been tied up or not? So all these things we are supposed to know. Now, I'm sharing here some red flags. I'll quickly run through them. So these are basically the things that we also should know, okay, before representing our client. Because if these are there, then the banker is also going to ask these questions from us. I'm not saying that if there is a tax rate, then it's a blacklisted client. But what was the rate all about? What is the action that is there happening in the assessment? What is the result which is there? We are supposed to know. So if there is any default in any bank, now the default can be only also because of a very silly reason. The bank had to manually debit, they did not debit, so that's why there is a delay of 1 week. There was a holiday, things like that. Or there was there is a invocation of LC or BG because of lack of documentation to be provided at the time. Or there is any there is a change in scope of work, or the project cost of a particular project has increased to a large extent. Then there is any funds coming from other banks to pay off. Basically you are taking refinancing, but every time the repayment is there, the client is seeking more fund. There is long outstanding bills which are there. There is whenever the banker has to visit, there is a request by the borrower that okay, please don't visit this time, visit some other time. There is a significant increase in contingent liabilities. This list is not exhaustive. This is what I have seen in my career, and I have tried to sort of list them down. So there is increase in fixed asset without any increase in turnover, or there is unbilled revenue has increased substantially. There are very large related party transaction which are not there because of the operation linkage, but otherwise the aging is worsening every quarter. There is a frequent request for general corporate purpose loan. So basically, these are the red flag indicators, because the banker will obviously seek a lot of information, justification because of this, and why this particular thing happened, what is the company doing now. So, for example, if there is a significant worsening in the aging of the receivables, then we can say that okay, the company has had agency for collection of receivables, or now they are trying to diversify. They have made their credit policy stringent. They are now diversified to some other customers. So they can be things like that. Okay, so we have to give the justification for these. Then comes the loan covenants. So loan covenants, basically the conditions which the bank will put on our client. This is where we can, do lot of heavy lifting for our client. So positive covenants means the client will have to do this. Negative means that they cannot do a particular activity. For example, they cannot declare dividend till the time a particular level is reached. Financial means that any financial condition which has been put on by the client, for example, maintaining any particular ratio or not seeking funding beyond a particular level. And then non-financial covenant means any condition which is not related to the financials. It can be related to operations, it can be related to inspection, legal structure, anything like that. So this is the place where we can do a lot of heavy lifting. For example, if there's a condition that the client will have to maintain they will have to say, for example, get rated. They will have to do a credit rating within 3 months, and we see that okay, the client is doing very good next quarter results, so we should take more time from the lenders, saying that okay, give us 6 months, not 3 months, so that we can get a better rating based on the good results that we are going to see. So any positive or negative covenants, if they are saying that okay, the DSCR should be say at 1.6 level, 1.5 level, and we see that okay, that seems to be a little stretched, so we can ask the bankers, okay, look at the CMA that we have submitted, which you have only approved. How will the client fulfill this? Because any of the breach of any of these covenants beyond a point is also considered as a default. So we should make sure that the conditions are put are actually we go through the sanction letter in detail, and we go through each of the covenants also, and then we are able to find out what is best there for our client. Then this is a sort of a checklist which you can do before taking up the proposal to the bank directly. I'm not saying we should not discuss with the banker, but before even submitting the information, this is the information that we should obviously go through: financial statement projections, the CIBIL, the KYC documents, any valuation which the client has already gotten done, any investigation report, necessary required approvals for the project. You should yourself visit a factory once if it is possible. That will give you more conviction about the loan proposal or the business of the client. Doing site visits is not just the prerogative of the bank analyst. I think we as advisors are also supposed to know if we want to be a long-term advisor to our client. I've seen so many advisors who basically don't even have idea about what the product is. Okay, and they have been auditing that client for, say, for example, 5 years or 10 years. They will know, okay, ye product banata hai, but what is that market? Who are the major competitors? What is the manufacturing process? These are people don't even know that. Then I'm just taking an example, how to proceed with the proposal. So basically, if it is a project financing, you start with the feasibility, you start with the risk assessment, you find out what will be the funding mix, how the debt has to be structured, when will the funds come, how those funds are going to be monitored, utilized, then how the cash flow generation is going to be there. Now, a very common question which generally is asked is that, okay, if the what are the commercials of the assignment? The commercial of the assignment is that client has agreed to pay a particular percentage of that particular of the loan deal. Let me tell you, if we are just doing transactions based on success based, if you are not a old setup, okay, if you are not there somebody who has been there in 20-25 years, because now you have built a legacy and now the clients also know you, they are you're old, and they are, if you are there in the competitive market with very less experience, then make sure that you put this as a condition to take some for your work that you are going to do even before the transaction actually it has reached 50% stage. Your commercial should be decided accordingly. Okay, we generally don't take up this analysis and everything because लोग बोलते हैं यार इसके पैसे थोड़ा ना मिलते हैं. No, we are supposed to structure our commercials this way, because whatever percentage or whatever fees that you are charging your client, it is for your time and effort. So I'm not saying that we should exploit our clients, but at the same time, we should structure the commercials so as to give us the impetus to work towards this kind of analysis, to put in a lot of effort from our side. That is why you will find that good advisors don't work at 10 deals at a particular point of time if they're a small setup. Okay. If they're less than 5 employees, they will be working on 1, 2, 3 maximum transactions, because this kind of analysis takes a lot of time. And that is where you will get good referrals not only from the clients, but you will get good referrals from the bankers also. I'm telling you this from experience. Then risk identification, let's come back. Risk identification and mitigation is very important. We should understand what all risks are there, discuss with the client. The sector knowledge will help us in identification these risks, and then we are going to provide the mitigants also. So we try to make your way from just being a loan broker to a complete debt solutions provider. So that is the whole idea. Then tips for executing the transaction smoothly. So get involved with the client very early, when they are just planning. This is not in our hands when we enter into a transaction, but the sooner the better. Then the knowledge of the assessment process which is there done by banks. हमें जब तक पता ही नहीं होगा कि process क्या है, हम उसके अंदर how will we become expert about this, right? Then what are the risks and how we can mitigate them, how we can advise our client to mitigate them. Then building relationships. Obviously, if you provide good references, good proposals to your bankers, and you are able to provide them support, they will obviously take up your case on priority. They will try, okay, these are good, this particular advisor brings good cases, credible cases, cases with strong credit worthiness, good profile. So obviously bank also is very eager to lend. The eagerness which our client has to take funds, the bank also has that eagerness to lend. But then we can bridge that gap, right? I'm just trying to say that we can bridge that gap, not just by being a courier service, but being a debt solutions provider. So I think I have not shot up my time. Thank you so much for listening to me. If there are any queries, if there are any questions, I'm more than happy to answer them.
Yeah, sir. Sir, very on time, sir. There is a query. It's asked that how do bank analyze the credit score in case of companies?
So basically, for companies, there is a CIBIL for corporate sector also, but it is not in terms of the number that we have out of 900. But they have corporate CIBIL. Secondly, they run a credit report. So RBI has now made it possible for banks to share the credit information in relation to a particular account within banks. So there is a portal run by RBI which is called CRILIC. Every bank has a login to that. You just enter the PAN number and the name of the client, and you will get what all facilities have been taken up by that particular borrower, from which bank, how much has there been any delay. So before NPA, there is SMA 0, SMA 1, SMA 2. So whether client falls in any of these categories of delays or not. So all this information is available. So that is how banks are able to find out the credit score, not the credit monitoring assessment of the client.
Yeah, thank you so much, sir. As we had limited queries, so now as coming to the end of the session, I would like to thank you, sir, on behalf of CP committee and on my own behalf. Sunny sir, you have taken up the topic in a very simple manner, as I know that credit assessment in banks is a very vast topic, but each and every point was taken up in a very that it was a journey which started from creditability, different types of loans, asset-based, cash-based, then bank lending process, preliminary applications, disbursement, the common mistakes which are done. Then also you had not missed the revenue part of a chartered accountant, which should also be taken up. So very wonderfully taken up, sir. So I thank you on my own behalf and on behalf of CP committee for taking up this session and guiding all the audience in a very easy manner and for sharing your knowledge. Thank you so much, Sunny sir.
Thank you. Thanks a lot for inviting me. Thank you.
Thank you so much. Without much ado, we'll also be taking up the second session, which is going to be taken up by CA Harjit Singh Puri ji. Uh, the session, the topic of the session is practical tips for raising cheaper funds by large corporates. I would like to introduce CA Harjit Singh Puri ji. It's an honor to introduce, sir, a distinguished finance professional from the 1986 batch who has recently retired as the Chief General Manager, Finance, after a remarkable 36-year career with NHPC. During his tenure, he managed all key areas of finance, including financial concurrence, treasury, corporate accounts, taxation, contractor claims, fundraising, IPOs, and investor relations. He also served as a CFO and internal auditor for NHPC's joint ventures and led finance division across various regions and projects. A respected speaker, CA Puri sir frequently addresses topics such as professional opportunities for fresh CAs, for new CA professional, EPS 95 scheme, and practical tips for interview preparation. He has also represented NHPC in investor presentations, making him a making him a wealth of knowledge in finance and corporate governance. This was a very brief introduction about Puri sir. I would like to now invite Puri sir to please take up the session.
Good evening, everybody.
Good evening, sir.
Am I audible?
Yes, sir. Yes, sir.
Yes. First of all, I am very thankful to CP Committee of ICAI who has given me the opportunity to attend this webinar and giving the tips on the practical tips for cheaper fundraising by the large corporates. Actually, I remained in charge of the treasury division of my company, which was dealing with the corpus of almost 1 lakh crore rupees, which was basically raising of the funds, investments, this investor relations. One thing our moderator has not mentioned, I was director in 4 Schedule A companies also during my tenure. It was NHDC, joint venture of NHPC with the MP government. One was Power Trading Corporation, PTC India Limited. I was director there, Power Trading. Then Lanco Tisa, which was 100% subsidiary acquired by NHPC. Then another Bundelkhand Solar Urja Company, which was a joint venture with the UP government. I was director there. I was chairman of audit committee of the NHDC Limited, our joint venture with the MP government, and CFO in our Chenab Valley Power Project Private Limited, which was joint venture of NHPC and JKS PTC. Now coming to our point, regarding documentation of the loans, elaborately it has been dealt by Mr. Sunny Sabharwal. Now my discussion starts thereafter. Actually, I am presuming a situation, rather the company from where I have come. It is Schedule A company, Navratna company, having AAA rating from the domestic credit rating agencies and international rating at par with the sovereign rating. So in that strong position, we have got so many options for raising funds. So fundraising has to be on cheaper side, because once we as a chartered accountant join a large corporate or we are in a practice, our client, our employer expects that we should raise the cheaper fund for them. Because cost of fund has a direct bearing upon the cost of a company. Cost of the product of the company, cost of the services of the company. And if we manage them properly, of course, our margin increases, our cost get reduces. Now, before we coming to understand how we can raise the cheaper funds, because I just want to tell, when I was in charge of my treasury division and head of finance of my company, which is now it is Navratna company, for inviting deposits and for taking loans, we used to invite the competitive bids. Means we dictate the terms, not the lenders dictating terms to us. Because we have to understand one thing very important, that interest rate on deposit and lending are deregulated. It is not in a regulated industry. Banks are free to decide the rates, and bank often adjust deposit rate to attract the funds. That concept we should understand. That is the reason we generally see rate of loan and rate of deposit are different by all the banks. It is because of that. So before we understand that how we have to raise the cheaper funds, we have to understand certain things, certain basic things about this industry. First of all is SOFR. What is SOFR? This is secured overnight financing rate. These are benchmark rates when we raise fund from abroad, from multilateral agencies. We should know, because banks and multilateral agencies take margin or spread on that. We should know what are these basic rates. Then LIBOR, London Interbank Offered Rate. Although from January 2022, LIBOR is no longer used to issue new loans in US. Euribor, Euro Interbank Offered Rate. This I am telling because these are the benchmark rates. Till we understand what is the basic cost, how we will decide the reasonability of rates. MIBOR, Mumbai Interbank Offer Rate. Now coming to another issue, we see that we have issued the bond on private placement. What is this private placement? Private placement of debt securities directly with the small group of pre-selected institutional investors like insurance companies, pension funds, asset management companies. Because whatever bonds we were issuing in our company, it was on private placement. Now, debt security, it is being generally used. What is debt security? It's a document which creates or evidences a debt obligation. ये स्लाइड में चल रहा है, अब नेक्स्ट स्लाइड ओपन कर दे आ जाए.
Yeah, should we share the slides, sir?
Yeah. Second slide में होगा.
Yeah, is the slide visible?
Yeah, बिल्कुल correct.
Yeah.
Now, third important thing is about credit rating agencies. Now, question comes, why at all we require the credit rating? This is the requirement of lender. Because highest your credit rating, lower the interest rate you will fetch from the market. Like we were having the line of credit limit from LIC, 6,500 crores. And their first condition was that you will continue to maintain AAA rating. As soon as your AAA rating reduces, the loan will be immediately repayable, or we will review the rate of interest. And now coming to the leading credit rating agencies, which are being recognized by the lenders. These are basically, although there are so many credit rating agencies are in the market, but 4 are widely recognized, like ICRA, CRISIL, India Rating, CARE. These are recognized. Highest rating, that is AAA rating. Lowest, default. The company has made default. इसको थोड़ा आगे कर लीजिए स्लाइड. Now the leading, back. Yes. It's okay. Now leading international credit rating agencies are Moody's and Standard & Poor. Their ratings are recognized when we take the fund from the abroad. Now coming to the international rating agency of the country, that is BBB minus long term. And I was privileged to work in a company which has an international rating at par with sovereign rating. Next. Now, there is one very common term used is book building exercise. Book building exercise, I just elaborate in a simple language. Suppose I require 1,000 crores of long-term loan. I go to NSE or BSE site after completing all documentation. First 100 crore, I am getting at 6.9. Another 200 at 7.0. Another 200 crore and 7.1. And finally, 200 crores at 7.2. At 7.2, my book gets completed and my 1,000 crore loan will be raised at 7.2. Book building is exercise for discovery of fair rate, efficient price recovery, which they say. Now there is one very common issue comes. So next, green shoe option. Now green shoe option is that it is a provision in an underwriting agreement that grants underwriter the right to sell investor more bond than initially planned by the issuer. Now, its question is, we can understand in that way. Suppose I have a requirement for 1,000 crore, but 200 crore is my immediate requirement. So I see how the market is operating. Suppose my peer group company has also come for raising loan at that time. So what will happen? Rate may shoot up. So I may decide to keep my original size to a minimal level and rest I will keep in the green shoe option. And in that I have given the example of IRFC. They in February 2024 were to raise the bond of 3,000 crores. They kept 500 crore as basic size and 2,500 crore in green shoe option. Means they will observe what the rates they are getting. If rates they are getting is in excess of the benchmark rate, which are prevailing there in the market, naturally they will stop there and raise the basic. Actually, you will know if you have invited the quotes at the stock exchange and you don't take the money, you are debarred for the issue for 7 days. So that is a problem. And that affects your goodwill also, credibility also in the market, that you are asking for the quote and you are not raising the funds. Next. Now, very common term that is used is moratorium period. What is a moratorium period in the loan? It is a period during which borrower is not obligated to make payment. Now this term is rightly used and this clause is invoked mostly in the cases because where we are having a construction project. This has a construction or gestation period of 3 to 4 years. After that, it will start revenue, giving the revenue. Once we are not getting the revenue, it is very difficult for us to pay the loan, pay the interest. For that, we can only take another loan and pay the debt. So that to avoid that situation, that moratorium period clause is widely accepted in the loan agreement. Now coming to convertible security, that allows the investor to convert its debt security into shares in the issuer at specified time and price. Conversion. They are allowing the conversion of debt security into shares of that company. Now there comes the exchangeable security. Now there is just one difference in that. They allow investor to convert its debt security into share in third party company at specified time and specified price. Now coming to the marginal standing facility that is very commonly used, a provision made by RBI which scheduled commercial bank can obtain liquidity overnight if interbank liquidity completely dries out. Actually, these are the terms which has a impact on the interest rate charged by the banks and financial institutions. Marginal cost of fund-based lending rate, MCLR, is a minimum interest rate a financial institution need to charge for a specified loan. Means it is a basic rate. They say that this is the minimum rate, which is the costing of the interest to the bank, and that is their expectation that they must get this minimum rate from the customer. Next, repo rate. Repo rate is the rate at which the RBI lends money to the commercial bank in the event of any shortfall of the fund. And repo rate is normally in the range of 6.5. It is still in the 6.5. And reverse repo is just reverse of that. RBI borrows money from commercial bank by selling securities. It is generally at 3.35%. Actually, repo rate has direct impact on the rate of deposit as well as rate on loan. Now, 3-month treasury bill rate is the yield received for investing in a government's issued treasury security that has maturity of 3 months. Actually, sometimes we get a facility from the bank which they link with 3-month treasury bill rates. It is at present around 5.17%. Now, cash reserve ratio, that is also very important, is the minimum percentage of cash deposit is specified by RBI that must be maintained by every commercial bank as per requirement of RBI, and cash reserve ratio is computed as percentage of net demand and time liability of each bank. Now, statutory liquidity ratio is the bank liquid assets to its net demand and time liability, and minimum liquidity ratio as on date prescribed is 18%. Means if a bank has less than that liquidity ratio, depositor will not have a comfort with the bank. So that can be from the deposit point of view. Here I will like to tell you, for deposit, for surplus money deposit by the Navratna, Miniratna and Maharatna companies, Government of India has specified that you can deposit money 60% with public sector bank, 40% with private sector bank which are having minimum net worth of 500 crores and capital adequacy ratio minimum as prescribed by Reserve Bank of India. Next. Now, statutory liquidity ratio, that is also minimum 18% is specified. Means for every rupees 100 of deposit in a bank, it must maintain 80 rupees 18 in the form of liquid assets. Now, next is sovereign guarantee fee. Now, sir, that is very important from that point of view. When you raise funds from abroad, so you cannot offer your any assets in India as a collateral. In that case, foreign banks or foreign multilateral agencies ask for the sovereign guarantee. Sovereign guarantee is a certain amount of physical risk at the stage of guaranteeing quasi-sovereign borrowing. To hedge the risk associated with guarantee, government has put a mechanism to charge a risk-based premium from entities whose loan and interest are guaranteed by sovereign. At present, this rate is 1.2%. 1.2% of the loan is charged by Government of India as guarantee fee. Coupon rate is the annual income an investor can expect to receive while holding bond issued by the par value. एक पीछे is it next? Next. Yes. Now our basic trust comes. Actually, you people must be knowing that borrowing power in any corporate is vested with the AGM shareholders. Shareholder approve the total borrowing of the company. And for further processing of the borrowing, they delegate different powers to the MD, CFO of the company. Now question comes, actually I remained the head of the treasury division, and when there is a loan requirement, suppose we have a loan requirement of 5,000 crore for 10 years with moratorium period of 2 years. So we have to take this specific proposal to the board, and board members have only one financial directors, are mostly non-finance directors. They want to know from which particular mode we should raise the fund, which is the cheaper mode. So they want analysis, they want input in the board agenda note from the finance executive who is in charge of the treasury, as well as the CA professionals who are in the practice, how they have to advise to their clients. Now, popular mode of fundraising as in vogue nowadays is term loan from the bank, NBFCs, LIC, actually they are spelling LIC, etc. Second is bond. Third is external commercial borrowing. Now, coming to the point, when we are deciding the time or mode of the fundraising, we have to see what is the liquidity position in the market, availability of other issues in the market, and future expectation on the movement of the interest rate, etc. Yesterday also I was sitting with some financial analyst. He was telling, Mr. Puri, interest rates are going to decline. So we have to see that pattern. Once we opt for the term loan, it is raised for a fixed period, but it has an option for prepayment. You can prepay the loan. Bonds are raised for a fixed period at fixed rate of interest. External commercial borrowing, yes, this is done from the foreign banks, multilateral, bilateral agencies in the country, in the currency of that country. Next, please.
Puri sir, Akshat ji will be sharing the screen after this. Just a second.
कोई नहीं.
Yeah.
अक्षय बोल next कर लेंगे अक्षय जी.
Akshat ji.
Yes.
Is it visible, sir?
Yes.
Yes,
Thank
sir.
you, Akshay ji. Thank you. Now the पीछे back वाला back. Yes. It's okay. Now the basic question which has to come to the mind of a finance executive who is dealing with the treasury is to see that what is the trend of future interest rate. If the interest rate are expected to fall in the future, we must go for the term loan from the bank oblique and NBFC, because here we have an option to make prepayment of the loan and swap it with a cheaper loan at appropriate date. But here there is a catch. Actually, we have a practical experience with the LIC. LIC, we had a line of credit limit of 6,500 crores. In the course of the repayment, we observed that the LIC rates are higher and the funds are available at cheaper rate from other modes. We asked them to allow us the prepayment of the loan. They kept a clause which is generally not there in the banks. They say you can prepay the loan only with our approval. And they did not give us the approval. But in other cases of the banks, this situation is not there. We raised the term loan from the SBI and we later on swap it with the bonds raised subsequently, because the rates of the bonds declined. To that end, we were having a substantial saving on that account. Actually, the point which I am sharing here is only out of my experience, which we were practically dealing while managing the treasury of our company. So, for deciding the cheaper mode of the long-term funding by the large corporate, paramount and foremost factor that should come to our mind should be the future expectation in the movement of the interest rate. Now, suppose in future, we expect that there is upward movement in the interest rate. In that case, we have to go for the bonds, because bonds we have raised today, interest rate will remain fixed during the tenure of the bond. And in case subsequently interest rate are hiked, it shall not have any impact on our interest cost burden. But in other words, we will not be required to bear the increased future cost of the interest. Now coming to the ECB, external commercial borrowing. Yes, we can raise the funds from them. Of course, the rate of interest are quite low as compared to Indian market. But there is a problem. There is a issue of exchange rate fluctuation, ERV, and we have to see the hedging cost plus interest cost and to see what is the lending cost to us. In case lending cost is more than the rate which is prevailing in the Indian market, of course, we will have to go for the domestic borrowing. Further, there is a restriction in raising ECB because they don't allow the raising of ECB for few purposes, like for investment in capital market or acquiring a company in India by a corporate, investment in real estate for working capital requirement, general corporate purpose, and repayment of existing rupee loan. For these purposes, they don't allow. Further, there is minimum 3-year lock-in period of the loan. Actually, we had suffered on that front. We raised some money in our company from a bank in Japan, and subsequently the rate of the domestic market get down. We wanted to pay that loan, prepay that loan. So RBI did not allow us. They told that you will have to keep this loan minimum for 3 years with you. And further, the bank also imposed the condition that, okay, you prepay the principal amount, but hedging cost, which you have agreed for the 5 years, you have to pay. So if we pay hedging cost, then where is our saving? Saving goes nowhere. So that was the problem. So that factor we have to keep in the mind when we are deciding these three popular mode of the borrowing. As far as ठीक now there is one very popular term that is used as a spread in the interest market. Actually, spread is the margin which is being charged by the banks or other financial institutions. Basic rate, benchmark rate is there, and after that, spread is margin they are taking from us. Next. Next. Now there we are coming to the type of the bonds which are being popularly used by the large corporates. Now, one important type of bond that is being used by the large corporates for raising the funds is masala bonds. It is a rupee-dominated bond issued by Indian entity in foreign market where both interest payment and principal reimbursement are denominated in rupee. Now, coming to the interest part. So, their interest part is 5-year GSEC rate, that is approximately 7% as of now, and up to 500 BPS spread. It means its rate of interest can vary between 7% to 12%. And RBI has allowed banks to issue masala bonds to meet their capital need and finance infrastructure projects. So their limit in a year is 5,000 crores we can raise. And as far as Indian undertakings are concerned, NTPC has raised 2,000 crores in 2016 at the rate of 7.48%. HDFC Bank has also raised the funds through masala bonds, 3,000 crores at the rate of 7.875%. Month semi-annual coupon payment in July 2016. Now coming to another type of bond, that is green bonds. It is a debt instrument issued by an entity for raising funds from the investors, the proceeds of which are earmarked for use towards financing green projects. Asset or business activity with an environmental benefit such as renewable energy, low carbon transport, etc. So these are the green bonds, which is also a popular mode of raising funds, which is being used by the large corporates and banks. And of course, Yes Bank in India came out with the first green bond in February 2015, 1,000 crores, 10 years, 8.85%. Another issue, August 15, 315 crores, 10 years, 8.95. Now, Exim Bank has also raised at fixed rate of 2.75%. So these I have given the examples. Actually, the point which I want to bring home is that whatever options are available in the market, domestic as well as international, we are to exercise the option raising cheaper fund for our corporates. And this I am going on a presumption that we have a top rating. Our sovereign rating, our international rating is at par with the sovereign rating. So we have a very good option of raising the cheaper funds. Next. Now there is one other type of bond is Section 54 EC bonds. Now, these bonds provide tax-saving options for those who have incurred long-term capital gain from sale oblique transfer of the long-term capital assets, being land, building, or both. The entire capital gain amount invested in these bonds would be exempt from under Section 54 EC as follows. Now, Government of India is giving sanctions to public sector undertakings for raising the bonds under Section 54 EC of Income Tax Act. So, latest examples on that front is 5.75% Indian Railway Finance Corporation Limited has raised the bonds AAA rated, 5% REC AAA rated bond, 5% National Highway Authority of India AAA rated bond. These are all secured. Means company has offered collateral security of the assets for these bonds. Now these bonds come within for a lock-in period of 5 to 7 years. Bondholder cannot transfer or redeem the bond before completion of lock-in period. Investor steadily earn 5.25% interest rate, and maximum cap of investment in these bonds is 50 lakhs per financial year. Now coming to the tax-free bonds. These are the bonds, fixed income instrument, and their interest is exempted under Section 1015 of the Income Tax Act. Now government of it is allowing these bonds to be issued by government companies, municipal corporation, public sector undertakings, and other infrastructure companies. And I was a privileged employee of that company who got this approval from the government for two of the 10 bonds. Now, as of now, NHAI, PFC, IIFCL, BUDCO, IREDA, REC, NHB, NHPC, NTPC, these all raised long-term bonds 10 to 15 years under this group. And the rate of interest in these tax-free bonds is around 5.5% to 7.5%. This is an ideal investment option for high net worth individual and for the company who is raising this money through this tax-free bonds. Their interest burden is quite less as compared to other bonds. Now, before raising of the bonds, these bonds, permission from Income Tax Department under Section 281 is required. Now, with effect from 1st April 2019, SEBI has come out with a framework that large corporates to raise not less than 25% of its incremental borrowing during the financial year by issuance of the debt security. It means that irrespective of the economy of the rate, 25% of the incremental borrowing shall have to be done by large corporate from bonds with effect from 1st April 2019. Now question comes, who are the large corporates? Now they have defined every listed company is a large corporate. For the purpose of implementation of this section. Further, a listed company having outstanding long-term borrowing of at least 100 crores, credit rating of AA, and above and target to finance themselves with the long-term borrowing above 1 year. Next one. Yes. Here I have put the indicative rate which the foreign multilateral and bilateral agencies are charging from projects in India. I have just brought down an indicative table. So World Bank, if they are funding 15-year loan, their interest rate basic 3.021 SOFR spread, which I have mentioned, is the margin 130 BPS 1.3 sovereign guarantee fee, which I have mentioned that government is guaranteeing your loan because for foreign loans you cannot mortgage or pledge your assets in India. 1.2%. Effective rate is 5.5%. These rates does not include the hedging cost. Asian Development Bank, 15 years loan when they are giving 4.877. 6 months USD LIBOR, 60 BPS is their spread. 1.2 is their sovereign guarantee. 6.7 is their effective rate. JICA, they have got a fixed rate, 1.3. There must be slight revision that I will also check. I am giving the basic idea of that. Sovereign guarantee fee, 1.2. Effective rate coming to 2.5%. KFW, this is the Bank of Germany. Their rate is 1.25 to 1.6. 1.2 will be sovereign guarantee fee and total effective rate is 2.8%. New Development Bank, 15 years, 4.87 basic rate, LIBOR, 110 basis point spread, 1.2 sovereign guarantee fee, and 7.1 is their effective rate. France Development, 1.6 rate, 1.2 is sovereign guarantee fees, effective rate is 2.8. Next. Now there is a new area where government has come out with a proposal and they have kept a target of 6 lakhs crores for raising the money by the companies through asset monetization. And this is the 4th year. Up to last 3 years, they have mopped up 3.85 lakh crores. Now, asset monetization, the government says that is a process of creating new source of revenue for government and its entities by unlocking the economic value of unutilized or underutilized public assets. Actually, government wants, particularly for their own companies, that you meet your capital requirement through asset monetization. Actually, asset monetization different from privatization. It signifies structured partnership with private sector under certain contractual frameworks. Asset monetization has two motives. First, it unlocks value from the public investment in infrastructure, and secondly, it utilizes the productivity in a private sector. Now, asset monetization aims to tap the private sector investment for new infrastructure creation. The option for the asset monetization includes slump sale, demerger, hive-off, outright sale, contractual structure for securitizing future cash flows. Now, coming to the last option, it is very much in vogue. In our company also, we monetize the ROI of 5 to 10 years. It means for 5 to 10 years, we invited the bids from the parties, and whosoever offered the lowest discounting rate, we monetize that ROI. And here the rate of discounting comes around to between 7 to 8%, and we get the money on the zero date for financing of for meeting the capex requirement of the company. So this is very popular mode. Next. So next very popular mode of asset monetization is InvIT, Infrastructure Investment Trusts. Infrastructure Investment Trust that work like mutual fund and are regulated by SEBI. We can understand it a general way. Suppose I have a project which is generating constant revenue. I transfer it to the InvIT. I keep the 15% share. The sponsor has to hold at least 50% of the cost. Rest has to be trustees are to invest, and their components are sold in the stock exchange, listed, and the condition is that 90% of its total cash flow is distributed as dividend to the investors. So basically, this you can say is this sort of a privatization type of issue, because the ownership goes, and company who has transferred that asset, transferred that project to the InvIT will get the money to meet its capital requirement, and ownership goes. 15% initially kept for making this transition to meet the transition phase requirement, so that the new management does not get any issues in the further execution, further running of the power station. So another issue that we used to face was the short-term funding, whether we have to raise short-term loan or we have to take loan against FD. We used to compare how much margin they are asking. So in our case, they used to ask the margin of 25 BPS. So 25 BPS plus interest on the FD, and if it is less than the short-term loan available in the market for that period, we go for that advance against FD, or if it is on a higher side, we go for the short-term loan. We have to compare. This analysis we have to usually put up to the management. Yes, we are doing like this. So actually the role of chartered accountant in any industry is not just restricted to the preparation of accounts. We are expected to be expert in raising the cheaper fund for our corporate. From there only efficiency comes. Now there comes a point of bridge financing, interim financing, gap financing, swing loans. Actually, it is a form of temporary financing intended to cover a company's short-term cost until the moment when regular long-term financing is secured. You have to suppose your long-term loan is taking time and you have a requirement. So you may raise the fund for 3 months, 6 months to meet that gap requirement, raise the complete loan, repay the short-term loan with the long-term loan, and long-term loan requirement goes further. So that is the situation. So that's all from my side from this issue, and I invite the any question from the persons who have linked with this webinar. Any issue?
No, sir. No queries, sir.
Okay, right, no problem.
Yeah. So, wonderfully taken up, sir. Actually, there are various things which have been an eye opener right now, which we have got to learn. Being that what are the different rates, the way the different agencies, book building process, how the cost of funds is to be analyzed. Also, what are the various rates like repo rate, CRR, SLR. Uh, we can have term loans, bonds, external commercial borrowing also can be done. Sir, all your 36-year experience you have put up, I know that is not easy to put it up in 1 hour, but you have done full justice to the topic and you have given us an idea how the funds can be generated, what are the various ways. And also you have emphasis on a very important note that chartered accountant is not only just for preparing the financials.
Yes.
More of one that to get best what we can say best way and best funds in a very effective rate. Sir, I would like to share that we have 343 participants live with us. So, on behalf of CP committee, on my own behalf, I would like to extend a hearty vote of thanks to Harjit Singh Puri sir for sharing all his knowledge and for providing us the various uh, funds, raising various funds in a very cheaper financial options which are available. And sir, I would like to again thank you on my own behalf and on behalf of CP committee for sharing your knowledge and for giving your time. And also extend a hearty vote of thanks to all the participants for joining in for the session. Thank you so much, sir.
Thank you.
Thank you. Thank you.
Thank you so much, sir.